Hello, everybody. Today it will be my 30th lecture series, and it will be Capital Market Part 2. So, on the last lecture series, that is on the 29th lecture series, it was about the Capital Market Part 1. I've given a little bit of introduction regarding the function of the financial market, the composition of the financial market, what is a capital market, and what is a money market. In part 1 to part 4, we have already discussed about it. But if we go deep into the aspect of the capital market, which is the main area that we need to know, how capital market works, how what are the areas we need to study about the capital market before entering into the capital market, which are the areas that we need to study, and what are the main areas of investment. Actually, the investor actually think of stock market, the equity market, the stock market, the stock exchange, Bombay Stock Exchange. This Reliance share is going up. For example, I'm telling about State Bank share is going down, Aditya Birla share is going up, or any mid cap share is going up, small cap is going down. You'll see in many websites, in moneycontrol.com, in CNBC, the money market, and also there are many channels. For example, Bloomberg channel is also there. So there are many informations which actually revolves around the capital market, the stock market, indices. Now, before going into the deep aspect that how capital market works, what are the various modes of capital market, how the investment takes place in capital market, which are the areas we need to look and study before entering the capital market, what kind of newspaper or what kind of magazines or the television shows or the YouTube channels, and how you're going to assess the company shares or the equity or the bonds or the portfolio or the derivative or the hedge fund and many other instruments which are available in the market, and the commodity also. So before going into this aspect of kind of transactional activities, we have to know that how capital market works and what is capital market. So if you go deep dive into the capital market aspect, a capital market can either be a primary market or a secondary market. Now, what is a primary market? In a primary market, new stock or bonds are issues. I've given a lecture on lecture series on IPO, initial public offer. The initial public offer is something which actually main composition is the of primary market, and where new shares or new bonds are being issued to the investors, often via a mechanism known as the underwriting. Underwriting is something where there are underwriters who actually take the responsibility from the company to issue shares to the investors or the future stakeholders or the future shareholders who will become an investor in the company. They underwrite the shares to the investors. So the main entity seeking to raise these long-term funds, these are actually long-term funds. Capital market investments are always meant for long-term funds. So if you enter into the capital market thinking of your money to be invested in a short-term period and take a gain out of that, then you are making a fool of yourself. This is a place where you have to make yourself committed, and you should be committed to have a long-term investment in the areas of capital market. On the primary market are governments, which may be, for example, there can be local government, it can be national or can be municipal. Now, and business enterprises, for example, companies. Governments issues only bonds, whereas the company often issue both equity and bonds. And the main entities purchasing the bonds or the stock on the primary market include the pension funds, hedge funds, sovereign wealth funds, and less commonly wealthy individuals and investment banks trading on their own behalf. There are many individuals, there are many wealthy individuals, high net individuals who actually invest their own fund into this kind of wealth funds, and they generate money out of that. And they also have got their own portfolio managers or the equity managers on their own. They deploy. They don't engage any kind of firm over here. They actually engage themselves to invest this money into these kinds of funds, and and the investment banks also. Now, in the secondary market, we talk about the primary market. In the secondary market, existing securities are sold and bought. among the investors or the traders, usually in the exchange or over the counter. For example, you need to open a demat account. We'll cover this issue afterwards also in our future lecture series, that what is a demat account, how demat account operates, how an individual will open a demat account, and how it will start trading on the demat platform or the stock exchange platform or elsewhere. Now, the existence of a secondary market increases the willingness of the investors in the primary market, as they know to likely be able to swiftly cash out of the investment if the need arises. So in primary market, what happens is that if you invest in the IPO, then it immediately got listed on the stock market or the stock exchanges. So it becomes a secondary market. So you can, if the stock price rises, then there is an opportunity for you to gain out of that, and you leave the stock market by selling that product share on the stock exchange platform to other investors which are actually available, and you get the money out of that. Now, a second very important division which falls between the stock market or the capital market, for the equity, also known as the shares, which investors acquire ownership of the company, and the bond market where the investor become traders. Now, I would like to give you a little bit of difference between the equity and the bonds, because if you are planning to invest in equity, you become a shareholder or the owner of the company. If you invest in a bond which is being floated by any company, X company or Y company, then you become a creditor to that company. Bonds actually has got an interest out of that. The company has to pay the interest from the bond that you have invested. Whereas on the other hand, equity actually earns the dividend out of that. So what is that contrast of the capital market with the money market? The money market that we have discussed actually gives us an overall picture and used to raise a short-term finances, including the loans that are expected to be paid back as early as overnight. Now, in contrast, the capital markets are used to raise the long-term finance in the form of shares or equities, and the loans that are not expected to be fully paid back for at least a year. So I've already mentioned that capital market is mainly meant for long-term investment, and money market is for short-term investment, maybe less than a year. So funds which are borrowed from the money market are typically used for general operating expenses to provide the liquid assets for the periods. For example, a company may have inbound payments from the customer that have not yet been cleared, but need immediate cash to pay its employees. But when a company borrows from the primary capital markets, often the purpose to invest in additional physical capital goods, which will be used to help to increase its income. So it can take many months or years before the investment generates the sufficient return to pay back its cost, and hence the finance is a long term. So you'll understand, for example, if the payment or the company borrows from the primary capital market, often the purpose to invest in additional physical capital goods, which will help them to help in increase its income. For example, capital budgeting. For example, if any company proposes to invest in a factory or the constructing a building, an office building, a factory building, or purchasing any kind of the plant and machinery, then obviously for that it needs a huge amount of money, and that can be done only by floating the shares and asking the investors to invest the money. So it is a long-term investments. So together, money market and capital market from the financial market, as the term is narrowly understood. The capital market is concerned with the long-term finance, and in the widest sense, it is consists of a series of channels through which the savings of the individuals and institutions are made available for industrial and commercial enterprises and public authorities. The process of channeling the savings into productive investments is crucial for economic growth and development also, because moreover, capital markets provide opportunity for both individuals as well as the institutions to diversify the investments, thereby managing the risk. Now the picture will come into a little bit deeper, the risk and the return. When you have got a high risk you'll obviously have got a high return. If you've got a low risk, there is a low return. So, and potentially enhancing the return over the long term period. So I'm ending this session of the capital market part 2 by saying that if you want to enter into the capital market, there is always a possibility that the funds must be invested for a long period of time. Thank you very much for watching. We will continue our capital market series next time. Thank you.